Welcome to the Lend Academy podcast, episode number 45. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I am delighted to welcome Krista Morgan. She is the CEO of P2Bi. They are a small business lender in doing receivables financing. And there's someone I have known for actually a long time, since way before they started. Krista happens to live in Denver, and that's where I'm from. And she reached out to me. We had a coffee, I think it was probably 4 years ago, when they were still very much in startup mode, had nowhere near launching. So I've seen this company grow from an idea all the way through to a successful launch, and now they've been in operation for 15 months. Full disclosure, I am an advisor. I've been an advisor with this company, I think, since 2011, and it hasn't actually required a huge amount of work on my part, but they are someone that I've watched grow, and I believe in them. So on this show, we talk about her company. We talk about the process for borrowers, what kind of borrowers are doing receivables financing through P2Bi, how they're really disrupting the invoice finance industry. And of course, talking about on the investor side and what kind of advantages they provide for investors. Hope you enjoy the show. Welcome to the podcast, Krista.
Thank you, Peter. Very happy to be here.
Okay, so let's get started with giving the listeners a bit of background about yourself and how you came to start P2Bi.
Sure. Well, like all good finance executives, I got here by way of marketing. So I feel like that was the right career move.
Mm-hmm.
I was living in the UK. I lived there for 6 years and came across peer-to-peer lending really early on, actually, sitting around my kitchen table. And I thought to myself, how come people don't lend to people? And as it turns out, they did. And there was Zopa. And I just loved the idea, paid attention to the industry. And then years later, ended up, my dad and I were just having this conversation about factoring, because he had been working with this factoring company. And next thing you know, we were talking about peer-to-peer lending, and we sort of found our niche in the space that no one had tackled yet. And that's really it. And then I moved to Denver and decided to start this crazy company.
Okay, yeah. So let's just tell all the listeners exactly what it is your company does and what problem you're trying to solve.
Sure. So this actually evolved over time, but at this point, what we're solving is the gap really between the group of online lenders that provide up to $500,000 of, working capital to the banks, which more and more like to do the bigger 4 or 5 million deals. And what we're seeing is a large number of companies in the middle who still want better technology, who still want a good, fair, transparent, lending product, and they need a lot of working capital. And so that's the space that we're going after, trying to help, the kind of companies that are going into, they have great natural food products, or they have an awesome new, widget in Costco. They want a better working capital product, and that's what we're doing. So we're providing lines of credit, all backed by receivables and inventory to help these companies keep growing.
Okay, so then explain, it's receivables financing, would you call it? And explain exactly how is that different to factoring?
So now it's actually more of the product. We are migrating after a year of being a factoring company. We've actually learned that as you get into the larger deals, customers really want some more flexibility. And frankly, it's a real pain to be selling, 1,000 invoices to a company. And so we're actually moving to a hybrid it's like a factoring meets asset-backed lending line of credit. So you still have a lot of the legal protections of factoring. So our investors can still, feel that their money is safe. At the same time, we want to give customers some of the flexibility of a line of credit. And, it's really today's technology that lets us see into people's bank accounts and accounting systems and even some of their vendor systems that it really enables this type of hybrid product.
So does that mean you are owning the receivables, or does the company, or are you just sort of providing the line of credit with the company that still owns their own receivables? How does it work?
Yeah, so we technically purchase all of their receivables and we get all of the cash into our lockbox. But then the customer can log in and basically we take all those purchase receivables and give them a borrowing base. And we say, today, customer, you can borrow $200,000. And then they'll say, great, I want $75,000. And we just effect that transaction and give them the money that they need, and all cash in the lockbox is automatically paying down the line. Now, there's still some invoice verification in there. There's still some of the checks and balances of factoring, but the day-to-day, we're taking that invoice level transaction out of the day-to-day of the loan.
Okay, so they're not saying, right, here's $1 million worth of invoices. We want a check for $800,000 today. That's not what you're offering.
Well, they could do that. It's really just, so what we'll say is, hey, today, based on your invoices, you could borrow up to $1 million. How much would you like?
Okay. So then they might say, well, we need $200,000 right now. And so then they'll take that, but they know what their maximum line of credit is, right?
Exactly. And it can vary based on how big their invoices are, but then we still have a max lending limit that has to be manually increased if they want to borrow more money.
Okay. So, but then what if they're a growing business and they're suddenly the invoices, they've gone from 1 million to 1.5 million over the course of, say, 6 months. Does that mean their line increases automatically, or how do you handle that?
So we have reviews. We have a credit review process, and it happens really fast, in 24 hours. And it's actually one of our value propositions. We have a customer that we worked with for a long time that they needed $600,000 when we signed them, and they were at 2.2 million in 6 months. And that type of growth is actually perfectly suited to this crowd lending, peer-to-peer model. And it's something that almost no other alternative lender can match the speed of that growth.
Mm-hmm. Okay, so then what kinds of businesses are you seeing coming to you?
So we have a lot of staffing companies across different industries. So a lot of staffing and services companies, a lot of technology products. So we've got a SaaS line of credit specifically designed for SaaS companies based on their MRR. That's been a hugely popular product. And then on the receivables and inventory side, we're seeing a lot of natural foods. We actually are just going into the pet product vertical. So many pet product companies.
Right.
Yep. And really any kind of CPG. So you're selling into the big retailers, their payment terms really stink, and they'll put big purchase orders out. So you really need to be able to get some inventory financing as well.
Right. So let's just talk about that for a second. Is that the inventory financing that you're doing, is that backed by receivables, or is that a completely separate product?
So it runs in the borrowing base. So what we're trying to do is also streamline our own operation. So by moving to this line of credit structure, we can say, okay, well, for the most part, our borrowing base is a function of your receivables. However, on some of our big deals, we just signed Ronco, which is a big consumer product company out of Austin, and they also needed some inventory, and the line is so big, and the protections that we have in the company are so big that we're able to give them additional capital on top of their AR for inventory.
Okay, but you wouldn't do a line of credit just based on inventory.
No, no. So like some of those, I know there's some people that really specialize in that in the early stages. That's not our model. There really has to be, usually it's for the bigger deals and they have a lot of AR and we're supplementing their AR with inventory.
Right. Okay. So then what about the loan terms? I mean, what is the typical interest rates, the advance rate you're doing, the length of the term of the loan? Just give us a range of and a typical kind of deal.
Sure. So our lines range in size from about $500,000 to $4 million. They're 1-year revolving lines of credit, so renewable 1-year agreements. The typical terms, I would say right now, our interest rates are running from about 15% up to kind of 23, 24% all in. And it's everything now is based on an outstanding daily balance. So we are lending 80%. Your borrowing base is 80% of the value of your receivables for the most part. But we're still only charging on an outstanding daily balance. So we're actually moving to a very simple pricing structure that we think is important, because it's amazing how hard it is to figure out what you're actually paying.
Oh, I know. That's the whole thing. That's, there's this old business borrower bill of rights that's been going around, that the guys at Fundera, who I'm going to have on again actually to talk about at some point, they are, there's so many, it's apples and oranges and lemons and limes. There's just so many different varieties of loan products for a small business. It's not like a consumer loan. It's like, you can get a revolving line of credit, you can get a loan. Whereas there's factoring, there's, term loans, there's MCA. You've got so many different options. So I get it. And I think it's hard for a small business owner, particularly. I look at the typical small business owner is not a finance expert, and I can see the simpler, the better. I think that's great.
You know what, though? It is amazing how hard it has. So as we have introduced this new product, because we used to charge like a monthly rate on an advance rate. So you're actually paying more because you're paying on 100% of the receivables, but you only got 80% of the cash. And so now we're going out with a just flat daily rate. You multiply it, by 365 and you know what you're paying every day. And we have had amazingly a ton of pushback. People are like, hey, this rate is like 20%. And we're like, yeah, it's 20%. That's what you're paying. And they're like, but I have this term sheet that tells me it's 12%. And I'm like, great, send me your term sheet. We'll do the calculation. And the term sheet they have is actually like 33%.
Right. Exactly.
And it's really hard as a kind of, you're trying to be transparent, but it feels like we're the first ones to be transparent.
Well, you're not, believe me. I mean, there's a big movement afoot, and I think the small business area is full of opaque loan agreements that are, I am hoping, we're moving away from. But I think I appreciate the fact that you guys are trying to be transparent, because I think it's to me, it's better for business. It causes less friction, and it's just the right thing to do.
Sometimes not the easy thing.
Correct. Sometimes. So then you've got you've got a deal signed up, a line of credit deal. What information are you gathering, and what are you sharing?
So we gather a lot of stuff. I mean, we gather everything that you would expect: 2 years of financials, AR and AP. We gather tax returns, both business and personal, for 20% owners or greater. We take like copies of people's driver's licenses. We do background checks. We do credit checks. We do a lot of tax lien checks to make sure there are no outstanding tax liens. And what we really do is we pull together all the documentation. We summarize it in a credit file, and we present the summarized credit file to our investors. That said, if people want to see the underlying detail, we're willing to share it. We just don't make it public due to data privacy issues.
Sure.
So, but yeah, that's broadly what we're looking at.
Okay, So then how are you protecting the investors? What sort of security interest are you taking?
In almost all cases, we take UCC1 liens, plus we are buying the receivables, plus we usually do notification and verification of the invoices. So we're still doing a lot of those factoring type management processes that give investors additional security. And then we also have all the cash coming into the lockbox. And that's a big thing. We are now, you have to send the cash in the lockbox, not just for what you've sold, but really for everything.
Mm-hmm.
And so all of that cash, and it's good for you because it reduces your balance right away. So you'll end up paying less. But that's a huge protection for us. And then we're just working on, I think, like we talked about earlier, bank account integration, making sure, like just trying to protect against fraud in those scenarios.
Right. Sure. So let's just talk about fraud and bad debts and that kind of thing. I mean, it sounds like you're collecting a lot of information on the company, but then you're buying invoices that you've not, are you underwriting the final buyer of the invoice as well? Or, so answer that question and then talk about, fraud and bad debts and that kind of thing.
Sure. So what we do, so if I was to say like our underwriting is 100%, call it, 50% is really on the underlying credit of the company. We want companies that are growing 50% on the top line, they don't have to be cash flow positive, but we have to see a path to that. So a lot of attention on their balance sheet and their cash position. And then it's probably about, 30% on the owner. So, their personal credit, we do like personal guarantees. So, what's the character of the owner? And then the remaining is on the payers themselves. So we do look at it. But what I will say is because we're not an auction site where you're just selling one invoice, we really buy all of your invoices. And so we're willing to take your larger customers, but also the smaller ones. In natural foods, you get a lot of like independent grocery stores, for example.
Right.
And we will take those because we see the diversification of everything. And I'd say about 50% of our portfolio is kind of Fortune 1000.
Okay. So then if you're, as you say, you're buying all of the invoices. So for that, you may have in there companies that are that don't have very good credit. So how has it gone as far as collecting on all of the invoices?
Well, so far, so good. So far, we have suffered zero losses in our portfolio since May of last year. So we're running on about, 15 months of sort of very positive track record. We've purchased now just about $100 million in invoices. So we have had a default. We have had one customer default where there was an issue, like there was an underlying issue with the invoice. There was subcontractor lien, and it just got messy. We ended up collecting, and we have a settlement agreement from the owner. So that's being paid out over time. And that's really it. We've had a couple of clients like go into what we call like collection, where the account is not performing very well, and we've had to be quite strict with them and manage them out of it. But in all of those scenarios, we've collected our money and recouped investor money. So it's performed extremely well.
So given that you own the receivables, I imagine you've got to have some pretty, and you own a lot of receivables, you've got to have some pretty efficient collection processes in place. I imagine a lot of this is happening just month on month without any friction from you, without any intervention from you. But what do you do when, like, you see someone's just one invoice is, say, 15 days past due? What's your process?
So the people we have two people who kind of process accounts receivable all day, every day. And what they'll do is, so we monitor aging reports weekly. So we'll look at the aging report and we'll say, okay, what is there an account here that we're worried about? If one invoice is aging out, we go to the client and we say, hey, we'd like to charge this back. Like this invoice where contractually, they have to buy them back after 90 days. And usually with receipts coming into the lockbox, we will charge that invoice back against those receipts. So it's very it's in the normal course of business that an invoice may age out and we charge it back. If there are like a set of invoices that are aging out and we're feeling concerned, the first step is we call the client and we just try to understand what's going on. Tell us what's happening. How do we figure this out? We have had a customer on a payment plan before where like a percentage of every every receipt had to go and pay down this outstanding balance. So we work through issues, but very much in the normal course of business. I think as a borrower, as long as you're communicating with us, we will work with you and try to find a solution.
Okay, fair enough. So then what about how are you finding your clients? I mean, you said you mentioned a few different verticals. Are you going at this one vertical or at a time? What are you doing to try and bring people into the fold?
Yes, is the answer. We are going after verticals. So, for example, if you take something like natural foods, we build our own lists. We have a sales team. We do outbound calling and emailing, and we try to get people into the process. I mean, the great thing is that we have a product that no one else really has in our way. We have some really exciting new technology coming out for borrowers that makes their lives a lot easier. So we're so confident in that it makes those outbound conversations go really well. And I would say as a long term, I'm also a huge believer in inbound marketing, and we create a lot of content. We try to build the P2Bi brand because we actually think that in the lending space that brand is something a lot of people don't do that well. And that's that's the one advantage of having a marketing person running a finance.
Right. Sure. So, okay, well, let's switch gears onto the investor side of the marketplace. And who is investing today? What you're open to accredited investors, institutional investors? Where are you focused on?
Yes. To date, we've actually been focused on institutional investors. So we have a pretty large crowd of accredited retail investors, over 100 active investors. And so that's worked really well for us. But to scale, as we start to think about scaling the company, we really needed some more institutional partnerships. So we've been having a ton of those conversations, reworking agreements. I mean, as I'm sure you know, there's a lot of process and reporting and just sort of legal infrastructure that you need in order to take institutional capital. And so we're in the process of onboarding. It's a handful of new funds.
Okay. So then, and like you said, you've done 100 million roughly in the last 15 months. What is it on a monthly basis now? If I was a new investor coming along, how long would it take me to deploy $10 million?
Today, we think it's to deploy 10 million, it would take at this point about 3 to 6 months, given the other capital we have on the platform. So we have kind of on any given day right now about 10 to 12 million outstanding, and that's been growing pretty quickly. So we expect that number to look closer to 35 by next spring. So our goal is if we want to hit $1 billion in lines of credit in 3 years, we need to grow about 11.5% a month.
Right. And is that what's been happening, or what has been your growth rate?
Oh gosh, average growth rate has been high. I would say the past couple of months it's slowed down a bit just because we hired a new sales director. So we revamped our entire sales process, and we've been trying to onboard new capital. So it's slowed our growth because we haven't had the capital to really go out and take on some of the larger deals. Because that's part of our issue, is that when you want to sign $1 million, $2 million deals at a time, you really need to make sure you have enough capital there to do it so that you're credible to those borrowers.
Right. And so then what about when you're presenting to investors, what do you talk about returns, average returns that an investor can expect?
So we say between kind of 8 to 14% on average so far. Our crowd has yielded, I think, netted out 11.66% with the 60-day liquidity. Right.
I know that is the thing that is very compelling, I think, about your product, is the fact that you can get double-digit returns with 60-day liquidity. There's not many products at all anywhere where you can get that kind of return. And as far as how that liquidity works, because you're churning out, you're getting the capital in on a daily basis. So an investor, just so I'm clear, someone puts $2 million to work on your platform, and in 6 months' time they say, yeah, I'm done, I want out. Do they get they get their entire principal back within 60 days? Is that what you're saying?
Yeah, I mean, we use 60 days as on average. What would happen is that they would ask to divest that capital, and then every piece of cash that comes into the lockbox, they're entitled to a proportional share of that cash based on their ownership percentage of the deal. And so we would release that cash to them as it comes in. We actually reconcile it weekly. So every week you get like a amount of cash into your account. And then we expect it to take no longer than 60 days. Some deals pay faster, some deals pay slower, but that's the general guidance for how long it will take. Right.
Okay. So when I was on your website yesterday and I saw it looked like there was 10 open deals right now. Are you I'm thinking about diversification from the investor perspective. How long would it take to get, diversified across, say, 50 deals?
Well, it depends how fast we onboard new deals. So, at this point, we're looking to onboard about, 5 to 10 deals a month this quarter is our goal. Some of them are smaller, some of them are bigger, but that's our goal. So we have about 35 active lines of credit as of right now.
Right. But not all of them are open to investors, right?
Well, not all of them are open. Some of them are full, and then some of them haven't quite started funding yet. Or we also have balance sheet capital, so some of them have balance sheet capital in them. So it depends on the deal.
Right. So, are you more investor constrained or borrower constrained, would you say, today?
I mean, look, today, probably it's a bit of both. I would say within the next 2 weeks, it'll be all borrower. And really borrower is our big focus as a team.
So you're about to onboard a couple of big clients then?
Exactly.
Right. Okay. So then, you've kind of got this sort of pretty unique product, and, are you, when you're talking to, obviously, investors have choices, even though the 60-day liquidity is a great selling point, but still investors obviously have choices and borrowers have choices. So when you're talking to, say, borrowers, who are the competitors that you come up against?
It's a lot of the old school kind of traditional lenders, so LSQ, Porter Capital. We come up against Bibby less so, but it's these kind of niche factoring companies for the most part. It's really, we sometimes get someone who's had an on-deck loan or a fund box loan and is moving over to us, but it's not, our rates are, usually a lot lower, and we're able to lend much larger amounts than those guys. So we're not usually competing head to head for deals. People are coming to us after they've had their on-deck loan.
Right. Okay. So then, so you don't really, there are obviously companies out there offering lines of credit, but it sounds like you're still playing in the factoring space for the most part, as far as what your borrowers are considering. When they're considering you, they're looking at other options on factoring.
Often, yeah. Some people, so with our SaaS product, we've seen people compare us to lighter capital, some of the revenue-based lending.
Right.
So it partly depends on the profile of the customer. But yes, I would say in large part, if you're talking CPG staffing, that's very much where factoring companies play in the, they love those deals.
How are you competing against them? You look at other players in the space, in the online lending space, where there's speed, there's ease of use, there's all kinds of advantages that these newer players have over the traditional players. Are you seeing that same advantage in your space?
Absolutely. Absolutely, we are. We have a company that's about to come on a $3 million deal they have 2 full-time people, Peter, managing their line. They're basically with a bank, but the factoring arm of a bank. And the CEO just came into our office and she was like, it is terrible. I have 2 full-time people. I have no idea where my receipts are. I can't figure out how much I'm paying. I can't get the reporting in a timely way. She was just, 2 full-time people is a lot to be managing your financing line.
Mm-hmm.
And when she looked at us and we said, look, this is how it's going to work, she couldn't believe it, like how easy it was going to be. So I think technology is that is the thing that really differentiates us, trying to use it in smart ways. We've used every factoring. We've gone and tested all the different factoring software in the industry. And we recently tested one where, I'm not joking, it only runs on Internet Explorer on Windows. And we're a Mac shop. So we buy a Windows license. And this is the latest and greatest of factoring software. And I was like, that technology is what their customers are interacting with, to get invoices in. It's not acceptable in this day and age. Someone has got to come in and disrupt it.
Right. And so the disruption that you're doing, I just want to go back a little bit to when you're first underwriting the customer, you talked about the tax returns and the different things. Are you using technology to shorten that process? It sounds like you spend a bit of time. What is the lead time from when a company says, "Yep, we want to go with you," till when they get their money?
So our overall sales cycle, we just did a big analysis of our data, runs at 57 days. However, the quickest we've done a deal end to end is in about, I think, 5 days. So it can go much faster. It's usually that customers don't have the information, or you're going back and forth on pricing or whatever it is. Right. We didn't follow up quickly enough. So we can already see some really easy wins to get that sales cycle number down. And we are working on technology to make it much easier to upload the docs. We're constantly revamping our underwriting list to make sure, do we actually need this document? Is this critical, or are we just asking for it? Is there another way we could get this information?
Right. Yeah, because that's I think I had Catherine Petralia from Cabbage on just a couple of episodes ago, and they're 100% automated, so you can get your money. They're doing much smaller numbers than you as far as the line of credit goes. But the way I look at it, moving towards an automated way is it's such a win for the small business if they don't have to go and hunt down all of the financial information themselves. And so what automation are you putting in on the borrower side?
So we're just about to launch our new, what we're calling our lending hub. And so that will enable customers to get us documentation in a much more streamlined way, so that they're not having to hunt through emails to figure out what's actually needed. So there's a lot of just dashboards and clarity on what's needed. We're working on financial system integration, and we're just working with some of our suppliers so for example, you can request tax returns through the IRS directly. And what would that cost, and how would we do that? And can we do that in an automated way? But there's no question, we want to move towards making it self-service, making it a lot easier. But full automation it's a tough thing when you're doing $1 million.
Yeah, I don't think that's probably not going to happen ever. Certainly not anytime soon, but yeah, when you're doing 20,000, it's a bit different, but yeah. Okay. So you talked about this getting to $1 billion in receivables. How are you planning to do that? How long, what's your growth plan? How are you what do you need to change today to get to that level of scale?
Well, we need to build an awful lot of technology between now and then to make us more efficient, so that, because as we think about scale, we really think about decreasing operating costs as a percentage of revenue. So, how do we do that? How do we just build great technology that really makes us more efficient? So that's a huge piece. And we have 4 developers. I imagine a year from now, we'd be at least double or triple that number. So a lot of technology build, a lot of just sales infrastructure, sales processes, making sure that we are very regimented as a sales team. We've just started working with SalesLoft. Everyone is on cadences. We are very focused at being an extremely efficient sales organization. And then, continuing to build the team and the culture. big believers that we hire really smart people and we let them make us better. And I think that is something that we're going to have to do if we want to hit $1 billion in credit lines. Mm-hmm. So that's our goal, $1 billion in signed lines of credit by, summer of 2018.
Okay. It'll be here before you know it. So before I let you go, I want to talk about your podcast. I know you're a marketing person and you have your own podcast. Why don't you tell the listeners a little bit about that?
Well, I really appreciate you mentioned that, Peter. Yeah. So my friend Lizelle Van Vuren, who runs an awesome meetup group in Denver called Women Who Startup, she and I wanted to take this Women Who Startup concept and put a podcast together. So we just finished our first season, 10 episodes, and it's interviews with awesome female founders and leaders. And we just talk about life as entrepreneurs, the pains of angel and VC fundraising, sort of pains of building a team and culture. So it's a lot of entrepreneurial stuff, but just with a female focus. But anyone can listen, we say.
Right. Okay. Well, that sounds great. Well, good luck with the podcast. Good luck with P2Bi. Thanks for coming on the show, Krista.
Thank you, Peter.
Okay. Talk to you later.
Bye.
So one of the reasons that I was attracted to this company when Krista first approached me many years ago was the whole idea of getting a high yield. We're talking a double-digit yield potentially with 60-day liquidity. Now, that's something that most small business platforms simply cannot offer. I've been an investor from, really before they launched, since they were in beta. And, I've got a small investment there and I continue to invest in new deals because I think this whole concept is very compelling. It's very compelling for investors. And I think once they get a bit more of a track record, I could see them doing very, very well. Anyway, on that note, I will sign off. Thank you very much for listening and I will catch you next time. Bye.